In this video, we're going to discuss claims, which is from Chapter 6 of the CPCU text. We'll start with an overview looking at the goals of the claims process. Broadly speaking, there are two goals of the claims process. First, it is important that the insurer complies with the contractual promise of the policy. And second, it's important for the claims process to support the insurer's financial goals. Let's look more closely at contractual promise fulfillment. This means providing fair, prompt, and equitable service or claims handling, either directly to the insured by adjusting their first-party claim, or indirectly by handling a third-party claim of someone to whom the insured might be liable. Throughout this video, we'll refer to the differences between first-party claims handling and third-party claims. Now let's look more closely at supporting the insurer's financial goals. Achieving financial goals is generally the responsibility of the marketing or underwriting department, but claims staff must also support those goals by, first of all, paying only legitimate claims and to avoid overpaying claims, which would result in lower profits or higher premiums for insureds or both, and to avoid underpaying claims, potentially hurting the reputation of the insurer, and fourth, to avoid overspending on the cost of handling claims. Since claims are generally the largest cost of an insurance company, certainly the cost of claims adjustment and the cost of losses are an important component of the profitability of an insurer. Now let's look at users of claims information. The marketing department of an insurance company recognizes that the claims service process is probably the most memorable part of an insured's experience with the insurance company. Even for an insured who has never made a claim, they tend to remember stories of bad claims processes from their friends and others more than any other service that the insurer provides. The marketing department can also gain valuable information from claims adjusters when claims are not paid. Unpaid claims might indicate an opportunity for a new product to be offered. Additionally, insurance producers, or those who sell the insurance policies, need to understand losses that have been paid out in order to help explain increases in rates. Next, the underwriting department uses claims information. If underwriters accept insureds who have losses greater than expected, then rates might be inadequate. So if an underwriter recognizes a frequency of claims among certain insureds, they may realize that they need to tighten their underwriting with those insureds. For example, let's take a group of insureds that has installed a new fire suppression system. If the fire suppression system hasn't worked as well as expected, underwriters may need to tighten their underwriting with that group of insureds. The actuarial department similarly needs to look at claims experience as well to make sure that rates were adequate and not excessive and not unfairly discriminatory. Additionally, the actuarial department works closely with the claims department on setting reserves. Generally, claims personnel are responsible for setting case reserves, which are the reserves set for each individual claim. The actuarial department correspondingly sets IBNR, or incurred but not reported reserves. So case reserves are set by claims personnel, but are very much related to IBNR reserves, which are for losses that have not yet been reported. Additionally, the public uses claims information to evaluate the performance of an insurance company. As I just said, the claims process is one of the most important aspects of evaluating the quality of an insurer, and lawyers use claims information in many cases to defend the insurance company or to defend the insured in a liability suit. And last, state regulators. They monitor claims practices to make certain that insureds are using good faith efforts in settling claims. Now let's discuss claims department structure. Let's first look at a typical claims department structure. Generally, the senior claims officer for an organization reports directly to the CEO, chief financial officer, or sometimes the chief underwriting officer. Then regional managers will often report up to the senior claims officer, or in some cases, staff claims representatives might report directly to the home office. Especially for larger insurance companies, there will be many regional managers reporting up to the senior claims officer. Let's look more closely at the roles of each of these. The senior claims officer may have a staff located in his or her same office, known as the home office claim department. They might also have several regional claims offices or branches across the country or around the world. And as I said, claims officers report to home office or to regional managers. Regional managers might oversee several different branches. Third-party administrators are structured similarly. Generally speaking, the region is determined by geography. There might be a regional manager for one state, but more often, the regional manager is over several states. For example, one might be over Louisiana, Texas, and Arkansas. Staff claims representatives report to regional managers or directly to home office. Staff claims representatives are employees of the insurer who handle most of the claims. They may be inside or outside field reps. Some insurers will use both. Field reps handle claims that generally require things like investigating the scene of a loss, meeting with insureds, claimants, and lawyers, and others involved in the case, such as witnesses to an accident, and inspecting damage. Oftentimes, bodily injury claims do not require a field rep, whereas property claims are more likely to require an outside investigator. Workers' comp claims often also require field reps, especially to monitor whether an employee is really injured enough not to return to work. Other claims personnel include independent adjusters. Independent adjusters are usually hired by insurance companies either because they're closer to the location of the loss or insured, or because they have some sort of special expertise, such as adjusting art claims, or because the insurer is too busy. This is especially common when there's a catastrophe loss and the insurer doesn't have enough on-staff personnel to adjust all claims, so independent adjusters are hired to supplement staff adjusters. Other claims personnel include third-party administrators. Some businesses choose to self-insure some or all of their exposures. However, they still need personnel to handle losses as they occur. It's often better to hire outside third-party administrators to handle losses, especially things like workers' compensation claims, rather than have your own employees handle those losses. Sometimes producers also act as claims personnel. Some insurers give their producers, in other words agents and brokers, authority to settle claims up to a certain level, such as to $5,000. And last, public adjusters. When a claim is particularly complex or contentious, public adjusters can be hired by the insured to defend their interests on the claim. Now let's look at how an insurer can evaluate their own claims department performance. Primarily, the focus is on profitability measures, with the most commonly used measure being the loss ratio. The loss ratio can measure losses and loss adjustment expenses, sometimes separately, to reflect the percentage of premiums being consumed by losses and the cost of adjusting those losses. When the loss ratio is going up on a book of business over time, this is a bad thing. When an insurance company has a high loss ratio that's mostly caused by high claims costs, the easiest way to sometimes combat a high loss ratio caused by high claims costs is to pay the demanded rather than the deserved claims settlement. In other words, instead of fighting a claim with an insured who doesn't deserve that claim amount, the insurer simply pays the amount they're asking for. Obviously, in the long run, this will not be an effective way to reduce overall costs, since the insurer is paying out higher claims amounts. Just remember that claims plays an important role in insurer profitability, since losses and loss adjustment expenses are usually the highest expense an insurer pays. Another aspect of performance is quality. Insurers can study their own successful claims in order to set best practices standards, or in some cases use other insurances' experiences. A common example of a best practice is that an insurer requires its claims personnel to acknowledge claims within 24 hours of the report. Another way to evaluate quality is through claims audits. Claims audits gather statistical information on claims. We'll talk more about claims audits later in the lecture. The quality of the claims department performance also can be evaluated by customer satisfaction. These days, it's especially easy to get customer satisfaction or dissatisfaction reports online. Claims managers and supervisors usually do respond to both compliments and complaints about the claims process, but insurers have to respond to complaints. Complaints might come directly from the insured or from a claimant or vendor. A claimant is a third party to whom the insured is liable. It's important that complaints be investigated and followed up on in a timely manner, for the very reason that we discussed before. The reputation of the insurance company can be dramatically hurt by even one badly handled claim. Now let's discuss measures that are taken to ensure regulatory compliance. We'll talk about claims guidelines, policies and procedures, controls, supervisor and manager review, and claims audits. Claims guidelines, policies, and procedures might include a specification of when an independent adjuster should be assigned. For example, when a claim appears to exceed a certain dollar amount or level of complexity, or when it's in a different territory from where the claims adjuster normally works. It also might outline a series of steps or procedures, and it can be used for training new personnel. Also, having claims guidelines provide evidence of good faith procedures. When there is a dispute or complaint on a claim, the insurance company can show that they've earnestly worked to have good faith claims procedures. Claims guidelines, policies, and procedures might also require that a claims diary and/or an activities log be kept, which we'll talk about soon. Now let's discuss controls that are used to ensure regulatory compliance. Examples of controls include reports, access, and authority. Let's look at an example of each. First, an example of the benefit of reports. Reports can indicate data entry errors, like a case reserve error. If a claims professional accidentally adds an extra 0 to a case reserve, this would likely be a red flag to a claims supervisor in a report. For example, if most claims handled by this claims representative are under $10,000 and the adjuster puts $100,000 in the report as a case reserve, this would likely indicate a problem or an error. Additionally, reports indicate how many claims are assigned to independent adjusters in certain territories and might indicate a need to hire more staff adjusters in those areas. And claims reports can be used to review claims that are in litigation. Next, let's look at how access security controls can be used to ensure regulatory compliance. One example of access security is password protecting systems. Extensive information on individual claims are generally kept on the insurance company's information systems, so it's important to have those systems password protected. Highly sensitive information might be on those systems that are associated with the claims. Additionally, specifically restricting access to certain data to only some managers is another control. And lastly, to prevent unauthorized individuals from making any change to the system regarding a claim. The last example of controls is authority levels. Authority levels refer to the reserve amounts and claims payment amounts personnel are allowed to make. This ensures that only experienced, qualified personnel handle reserves and payment of certain levels. In fact, information systems can be designed to limit authority, especially when used in conjunction with passwords. So as a claims personnel, you might need to have a certain password in order to award certain claims levels. Supervisor and manager review is also used to ensure regulatory compliance. Diary systems for claims personnel can be used as reminders to handle certain parts of the claim, such as a reminder to call the insured. But the diary system can also alert the manager that it's time for him or her to review the claim. Additionally, supervisors and managers must check claims codes, the claims file, and the activity log. Claims audits are an important way to ensure regulatory compliance. These are a review of paper and electronic claims files. Claims audits can be internal or external. The purpose of claims audits is to examine the technical details of the claim. to ensure that procedures are followed and to verify appropriate and thorough documentation. Documentation of claims is extremely important, especially so that if there's ever a dispute, the insurer has the proper documentation to provide evidence that they followed the appropriate procedures. An internal audit is done by senior claims managers to ensure that the claims professionals complied with procedures and policies, and sometimes to review specific claims, especially those that are more significant. Actuaries also review claims files and do claims audits. Actuaries must regularly monitor claims reserves and compare the initial reserves to the final settlement amount and make certain that reserves are being set adequately. Underwriting departments also audit claims files to see the kinds of claims that are being reported and paid for. These might be a red flag to underwriters to tighten up underwriting standards for insurers with a certain risk characteristic. And lastly, human resources. One of the best things human resources can learn from a claims audit is how to better train future claims personnel. External claims audits are done to accomplish similar goals as internal audits and to examine the adequacy of reserves. Similar to why actuaries sometimes do claims audits, regulators want to examine whether or not the insurer is setting adequate reserves, and to review overall claims handling practices and make sure that there are no bad faith claims. And finally, when necessary, to investigate customer complaints. And these are done by insurance regulators at state departments of insurance. Now let's look at activities in the claims handling process. The claims handling process is not necessarily a step-by-step process. Various steps in the claims handling process might be done at various stages of the claim, but the first step is always to assign the claim. Other steps include identifying the policy and setting the reserves, contacting the insured or the insured's representative, investigating and documenting the claim, and determining the cause of loss, liability, and loss amount. Let's first look at assigning the claim. The claim might be assigned based on territory, type of claim, workload, or some combination of the above. A claims department might assign a claim to more than one adjuster, especially one that is a property and liability or third-party claim. For example, a car accident where the insured has property damage to his or her car and there's property damage to another car, as well as bodily injury loss to someone in another car. One claims adjuster might handle the property claim, and another might handle the bodily injury liability claim. And even a third might be assigned to handle the property damage liability. Claims representatives might assign an investigator or independent adjuster to the claim if necessary. Part of the claims handling process is to identify the policy and to set the reserves. But if it is determined through this step that the policy actually doesn't cover the loss, the insurer must notify the insured with a non-waiver agreement or reservation of rights letter. As I've been saying throughout this lecture, it is often the responsibility of claims representatives to establish case reserves. A case reserve is an amount of money that is set aside as a liability, which is an estimate of how much might be paid on that particular claim. There are various methods of setting case reserves. First, the average value method, which sets the reserve amount at the average amount of similar claims. Next, the round table method. This uses the consensus of two or more claims personnel who have independently evaluated the file. This might be used when the claim is a bit more complicated than with the average value method. Then there's the individual case method, where one claims adjuster uses his or her past experiences in handling similar claims to set the case reserve. Again, this is likely when the claim is a bit more complicated and requires more of an expert. Then there's the expert system method, which is a method of setting reserves by inputting certain characteristics of the claim into a system which will generate an amount for the case reserve. Similarly, the formula method is a method of setting case reserves by inputting certain variables associated with the claim and calculating an amount of the case reserve. And last, the loss ratio method. This means setting the case reserve as a percentage of the premium associated with that loss by multiplying the premium by the loss ratio. There's a somewhat dangerous practice called reserve stair-stepping. Reserve stair-stepping is basically setting up insufficient reserves initially and then adding to the reserves as bills come in. An insurance company should avoid reserve stair-stepping because it basically is underestimating a claim. But it is a bigger problem with longer tail claims like workers' compensation and most liability claims than it is with property claims, for example. Another step in the claims process is contacting the insured or the insured's representative. Additionally, the insurer must also contact a claimant if a third-party loss is involved. When this person is contacted, the representative might need to explain coverage and answer other questions. Many times, an insured has many questions about their policy and doesn't really understand their coverage or the policy exclusions. In this process, the claims adjuster is an extremely important representative. Keep in mind that the insured just had a loss, and many times this can be a very difficult process for the insured. It's important to try to keep the insureds as happy and satisfied as possible, even if the coverage is not as good as anticipated. Additionally, the insurer has to get information from the policyholder and supply a proof of loss form that can be later filled out by the policyholder or the claimant. The insurer must act in good faith. They must be careful not to mislead the insured about the potential coverage for this claim. There may be a need for investigating and documenting the claim. There are several different types of claims investigations. First, a claimant investigation, which is usually conducted first by taking the claimant's statement to determine the amount of damage and how the loss was caused and who is actually responsible for the claim. Then taking statements from the insured and any witnesses, and possibly doing an accident scene investigation, since there might be critical clues about the loss and about who is responsible and whether coverage applies. Next, there might need to be a property damage investigation to determine the cause of loss and the amount of damage. This is especially important when the property damage involves a business income loss to determine lost profits or loss of business resulting from property damage. There might also need to be a medical investigation to determine the cost of medical treatment and the expected duration of the treatment, as well as lost wages and any need for medical rehabilitation, and a prior claim investigation. There are industry databases that can be used to investigate whether prior claims have occurred, which can be useful to avoid paying for property damage or bodily injury that has previously been paid through a prior claim. Insurers use diary systems, activity logs, and file reports in order to investigate claims. Activity logs are daily logs of the insurer's activities associated with the claims. Additionally, part of adjusting the claim is, of course, to determine the cause of loss, whether or not the insured is liable in some cases, and the loss amount. If there are several causes of loss, the claims representative has to determine all of the causes and determine the responsible party for the event. So this includes making determinations about the cause of loss, about whether or not the insured is liable, and determinations of subrogation. Remember that when an insurer pays a claim to an insured for a loss caused by a negligent third party, the insurer then can recover from the negligent third party or from the negligent third party's insurer. This is called subrogation. And last, the insurer must also make determinations about coinsurance, which means that the claim might be reduced because the insured hasn't met coinsurance requirements. Finally, in concluding the claim, the insurer must negotiate an amount to the insured or claimant. If there's a dispute over the amount paid, alternative dispute resolution might be used to settle the dispute. Some policies, such as professional liability policies, might require alternative dispute resolution be used before the matter can be taken to court, but many claims are still handled through litigation. Finally, let's look at a framework for coverage analysis. Essentially, this involves answering a list of questions. These are shown on page 6.29 of the text. The questions include asking, is the person involved covered? Did the loss occur during the policy period? Is the cause of loss covered? Is the damaged property covered? Are the amounts of loss or damage covered, or do they exceed the limits? Is the location of the loss covered? Do any exclusions on the policy apply? And does other insurance apply? Many insurance policies have other insurance clauses, which exclude coverage for any losses that are covered by other insurance. And that's the end of our discussion of claims.